Stop checking your portfolio every 5 minutes. Stop reading mainstream headlines. Stop trusting analysts who missed a 164% silver move and are now calling it over. Your silver is safe, but COMEX right now, that is not a market, that is a crime scene, and I am about to show you exactly who committed it. Today is April 21st, 2026. 9 days from now, April 30th, is first notice day on the COMEX May silver contract. That is the day paper holders must decide, roll out, or demand real metal. And here's what nobody is saying out loud: the real metal is almost gone. COMEX registered silver vaults hold 78.6 million ounces. Total paper exposure written against those vaults, 384 million ounces. On the surface, this looks like a futures market doing what futures markets do. But the London Bullion Market Association published their vault data on March 10th, and what it shows defies everything the banks are telling you. The silver-to-gold ratio in London vaults has collapsed to 2.94 to 1. For the first time in modern history, below 3 to 1. Let me repeat that, below 3 to 1. For the first time in modern history, COMEX is where silver futures are traded in New York. When you buy a silver futures contract, you are buying a paper promise, a claim on silver that may or may not exist in physical form. Right now, registered silver is 78.6 million ounces. Open interest, the total paper claim is 384 million ounces. Grab your calculator. 384 divided by 78.6. That is 4.9 times more paper silver than physical silver. For every 1 ounce of real metal in those vaults, there are 4.9 paper promises written against it. Let me repeat that. 4.9 paper ounces for every 1 real ounce. May 2026 contract delivery window opens April 30th, 9 days away. If contract holders demand delivery at the rate the math implies, 7.5 million ounces per day, COMEX vaults are empty in 10 trading days, not 10 months, not 10 weeks, 10 trading days. And this right here is where JPMorgan Chase enters the story. What I am about to show you can only be described as nuclear. On March 10, 2026, the LBMA published end of February vault data. Silver to gold ratio, 2.94 to 1. Here is why that number is catastrophic. For the last 70 years, this ratio stayed between 6 to 1 and 7 to 1. 6 or 7 ounces of silver for every ounce of gold. That was the equilibrium. That was normal. Today it is 2.94 to 1. Grab your calculator again. From 7 to 1 down to 2.94 to 1. Grab your calculator again. From 7 to 1 down to 2.94 to 1. More than half of London's silver relative to gold is gone. And now look at the velocity. London vaults are draining at 664 tons of silver per month. 664 tons. That is 21.3 million ounces leaving London every single month. London's free silver float, the silver not locked inside ETFs, stands at approximately 4,355 tons. At 664 tons per month, that float is gone in 6.5 months. The entire free silver supply in London, the center of global bullion trading, exhausted in 6.5 months at current drain rate. Not one mainstream financial outlet is running this number. Ask yourself why. The person responsible has a name, none other than JPMorgan Chase. JPMorgan's commodities desk is the single largest short seller in the silver futures market. They have sold hundreds of millions of ounces of paper silver, delivery promises against vaults that cannot honor those promises at current drain rates. Their public position, stated through analysts and the media they influence: silver markets are deep, liquid, and resilient. There is no shortage of physical supply. Now look at what their own clearing data actually shows. COMEX registered inventory, 78.6 million ounces. Paper exposure, 384 million ounces. London vault ratio, 2.94 to 1. London drain rate, 664 tons per month. Reconcile those two things in your head. JPMorgan is not alone. HSBC, Standard Chartered, Citigroup, all holding concentrated short positions in silver futures, all publicly saying nothing is wrong, all privately watching the same vault data drain in real time. They are not shorting because they believe silver is overvalued. They are shorting because covering their positions at current levels means crystallizing losses that would make front-page news. So they hold, and they hope, and the vaults keep draining. Now look at the physical evidence, source by source. COMEX Warehouse reports, March 14, 2026. Registered silver 78.6 million ounces. Open interest 384 million ounces. Effective leverage 4.9 to 1. This is official CME Group data. Public. Verifiable today. LBMA Monthly Vault Data. March 10, 2026. Silver to gold ratio 2.94 to 1. First time below 3 to 1 in modern recorded history. Drain rate 664 tons per month. CFTC Commitment of Traders reports weekly through March 2026. Top 4 to 5 banks hold concentrated net short positions in silver futures, positions that have not materially reduced despite rising prices and shrinking vault metal. US Government Critical Mineral Classification 2025, Washington formally declared silver a critical mineral. AI data centers, solar panels, military systems, all consuming silver at a scale that permanently changed the demand equation. And here is the line that should stop you cold. The same government whose banks are shorting silver paper declared silver a national security asset. The left hand is shorting silver into the floor. The right hand is declaring it critical to national defense. Same government, same time, completely opposite actions. Here is where the irony becomes something colder than irony. JPMorgan publicly tells clients the market is liquid, supply is adequate, premiums are manageable. Privately, their own clearing shows a 2.94 to 1 vault ratio in London. Their own desks are watching 664 tons drain monthly. Their own risk models are flagging May 2026 delivery stress with first notice day 9 days away. They know. They are not confused. They are not missing the data. They have the data before anyone else sees it. So why are they still short? Because the moment JPMorgan starts buying to close their short positions, the price moves violently against them. Their short position is the fuel for the next leg up. So they hold the line publicly. They manage the narrative. They call it seasonal. They call it speculative. And every day they hold that line. 664 more tons leave London. And every day they hold that line, someone in Asia and someone in the Middle East is taking physical delivery of real metal. One side is managing a narrative. The other side is taking home metal. In 1979, the Hunt brothers drove silver from $6 to $49.45. Not over 20 years, not over 10 years. In 18 months, 725% in 18 months. And it ended only when the exchange changed its own rules mid-game, restricting new long positions to protect the short sellers. That playbook exists, banks know it exists, but the difference in 2026 is that industrial demand, solar, AI, military, green technology, does not respond to rule changes. It does not get margin called. It does not panic sell. It just keeps consuming every single day, regardless of what paper markets do. And here is what this market actually is right now. Silver is a coiled spring. 6 consecutive years of demand outpacing supply by hundreds of millions of ounces. Governments classifying it as critical infrastructure. London vaults draining at the fastest pace in 70 years of modern bullion banking. Banks trapped in short positions they cannot cover without detonating the price against themselves. The spring has been compressed for years. Every ton that leaves London tightens it further. Every paper short that cannot be covered tightens it further. When it releases and the vault math says it must release, the move will be violent, fast, and it will leave most people completely unprepared. That is not prediction, that is arithmetic. There are 3 realities in this market right now. Screenshot this. Reality 1. The paper price is what your screen shows, set in New York, managed by institutions with 4.9 to 1 leverage against real metal, and supported by a public narrative that directly contradicts their own vault data. Reality 2. The physical reality is what the numbers show. London draining at 664 tons monthly. COMEX at 78.6 million ounces against 384 million in exposure. First notice day 9 days away. Reality 3. The gap between Reality 1 and Reality 2 cannot hold. When COMEX registered inventory cannot cover delivery demand, and at 4.9 to 1 leverage, it mathematically cannot. The paper pricing mechanism breaks. You are in one of 3 positions right now. Position 1. You are holding paper silver with leverage, 9 days from first notice day, on a contract where the vault math does not work in your favor. You need a decision today, not tomorrow. Position 2. You are holding physical silver, bought with cash you do not need back tomorrow. The vault data confirms your thesis. The drain rate confirms your thesis. The leverage ratio confirms your thesis. You hold. Position 3. You have no position and you are watching. The COMEX data, the LBMA ratio, the April 30th deadline, all of it is public. The decision is yours to make with open eyes. Tell me in the comments which position are you in right now. Check it yourself. Pull the COMEX warehouse reports from CME Group directly. Registered silver, 78.6 million ounces as of March 14th. Pull the LBMA Monthly Vault Data from their official site. Silver to gold ratio, 2.94 to 1 as of end of February. Pull the CFTC Commitment of Traders report. Look at the concentrated short positions held by the top 4 to 5 banks in silver futures. Track the London drain rate, 664 tons per month, and calculate how many months remain at that pace. The data is public. The math is simple. The conclusion writes itself. Here is what JPMorgan does not want you to know. They are alone in this position now. Their shorts are underwater. Their vault data is actively working against them. The institutions taking physical delivery. The sovereign buyers pulling metal out of London. The industrial consumers locking in supply. They are all on one side. JPMorgan's paper short is on the other. If you are holding physical silver right now, bought with cash, no leverage, no margin, no borrowed money, The screen number does not change your position. The structural deficit did not change. The 664-ton monthly drain did not change. The 4.9 to 1 leverage ratio did not change. The fundamentals do not move because a paper number moved. You are not the weak hand in this market. You are the one holding the real thing while the vaults run empty. This is Financial Joe alert. The paper says one number. The vaults say another. The math decides who was right. Check the data. Trust the arithmetic. Hold the metal. And tell me this. If COMEX vaults are at 4.9 to 1 leverage and first notice day is 9 days away, what happens on May 1st when the physical delivery window opens and the metal is not there? Because that question does not have a comfortable answer.